Most of what you've heard about Roth IRA versus 401k is upside down. And if you're over 40, that mistake gets expensive fast.
This isn't really a which one is better question. It's a bet on what your tax bracket looks like years from now, and most people are placing that bet without realizing they made one.
Get the bet right and the order barely matters. Get it wrong and you can hand the IRS thousands of dollars you never had to give up. Before we get to which account comes first, I want to show you how to place that bet on purpose, plus 3 moves almost nobody uses that can reshape your tax bill in retirement.
A traditional 401k skips tax now and gets taxed later when you pull the money out. A Roth gets taxed now and comes out untouched. Which one wins comes down to one thing: whether your tax rate today is higher or lower than it'll be in retirement.
The part that trips people up, most people guess at their future bracket instead of estimating it. A rough way to do that: take your expected retirement spending, add in Social Security, any pension, and planned withdrawals, and run that number through this year's tax brackets as a stand-in. If that lands you in the 22% or below while you're sitting at 24% or higher at work right now, traditional is probably doing you more good than Roth. If the numbers land close together or you genuinely can't tell, that's useful too. It means splitting between both isn't hedging, it's the right answer. Take a real example, because the abstract version rarely sticks. Say you're 47, earning $110,000, which puts your top dollar in the 24% federal bracket this year. Run the numbers on retirement, a paid-off house, Social Security starting at 67, maybe $45,000 a year in spending once the mortgage is gone. That level of income, for a lot of people, lands in the 12% or 22% bracket. That's a real gap. Every dollar you shift from traditional to Roth today gets taxed at 24% now to save you from paying 12% or 22% later, which is backwards. Traditional deserves more of your next dollar than Roth does here, even though Roth gets all the online buzz. Flip it. You're self-employed, income bounces around, and this happens to be a lean year where you're sitting in the 12% bracket. That's exactly the year to lean into Roth, because you're unlikely to see a lower rate than this one again before retirement. If your income is too high to contribute to a Roth IRA directly, for 2026, that phase-out starts at $153,000 single and $242,000 married filing jointly. There's a legal workaround called a back.
It works like this. You contribute money to a traditional IRA, no income limit on that step, and convert those same dollars into a Roth IRA shortly after. Since you already paid tax on that money going in theory, you owe nothing on the conversion.
In theory, there's a trap that catches people who've been saving for a while and don't know it exists. If you already have money sitting in an old traditional IRA or a rollover from a previous 401k, the IRS won't let you convert only your new after-tax contribution and ignore the rest. It treats all your traditional IRA money as one pool and taxes your conversion proportionally across that whole pool. This is the pro rata rule, and it's the single most common reason a backdoor Roth conversion ends up costing someone a tax bill they didn't see coming. In real numbers, say you have $93,000 sitting in an old rollover IRA from a job you left years ago, all pre-tax. You contribute a fresh $7,500 after tax and convert it right away. The IRS won't let you cherry-pick just that $7,500. It looks at your entire traditional IRA balance, $100,500 total, and says only 7.5% of any conversion counts as already taxed money. Instead of converting $7,500 tax-free, you'd owe income tax on roughly $6,940 of it. People find this out after they've filed, not before, and it's an expensive surprise. If this applies to you, the fix is usually rolling your old traditional IRA balances into your current 401k first, if your plan accepts incoming rollovers. That empties the pool the pro rata rule looks at and clears the way for a clean conversion going forward. This is exactly the kind of thing a fee-only CPA earns their fee on. One conversation before you try this yourself is worth it.
If you've already maxed your 401k for the year and you're still looking for more room, there's a strategy called the Mega Backdoor Roth, and it moves more money than the name makes it sound.
Your 401k actually has 3 separate buckets under the hood. Bucket 1 is your regular contribution, $24,500 for 2026 or $32,500 if you're 50 or older. Bucket 2 is anything your employer adds through a match. Bucket 3 is
The total across all 3 buckets can go up to $72,000 for 2026 if your plan allows after-tax contributions and lets you convert them, either inside the plan or by rolling them out to a Roth IRA. You can push tens of thousands of extra dollars into Roth space every year, past the number most people think is their ceiling.
Most plans don't offer this, so log into your 401k portal and look for a contribution type called after-tax, separate from pre-tax and Roth. If you see it, call your plan administrator and ask whether in-plan Roth conversions are available. If your plan doesn't support it, there's nothing to do here. This option isn't available to everyone, and that's not on you.
Here's why it's worth the phone call if your plan does support it. Say you're maxing your regular $24,500 and getting a $6,000 match, which leaves roughly $41,500 of room under that $72,000 ceiling. Fund even half of that through after-tax contributions and convert it every year for 15 years, and you're looking at well over $300,000 of additional money growing completely tax-free by retirement. Money that would have otherwise sat in an ordinary taxable brokerage account, getting taxed on dividends and gains every year along the way.
This last one is the reason the order actually matters. Not just which account you fund, but what mix you end up holding by the time you retire.
There's a stretch between when you stop working and when required minimum distributions force you to start pulling from traditional accounts at 73. During that window, taxable income can be unusually low. No paycheck, Social Security maybe not started yet. Some people use those low-income years to convert chunks of traditional money into Roth money, paying tax on the conversion at a much lower rate than they'd pay letting it sit and trigger larger required withdrawals later.
This connects back to Social Security in a way almost nobody explains alongside the Roth decision. Married filing jointly with combined income under $32,000, none of your Social Security benefit gets taxed. Above $44,000, up to 85% of it does. Traditional IRA and 401k withdrawals count toward that combined income figure. Roth withdrawals don't count at all. So the mix of Roth versus traditional you're holding by retirement doesn't just affect what you owe on that money directly. It can decide whether your Social Security check gets taxed too.
Roughly how that plays out, someone retires at 62 with $500,000 in a traditional 401k and doesn't start Social Security until 67. Those 5 years between retirement and claiming can have very little other taxable income. Converting $20,000 to $30,000 a year during that stretch, while staying inside the lower brackets, can move a meaningful chunk of that balance into Roth space before required withdrawals force the issue at 73, and before Social Security or Medicare premiums are even part of the picture.
That's the actual payoff of having some Roth money in place by the time you retire. Not just tax-free growth for its own sake. Flexibility. Room to manage taxable income deliberately during that window, instead of being stuck with one big traditional balance and no lever to pull.
So, which comes first? If you're getting an employer match, that's still worth capturing before anything else. Free money, no strategy required. Past that, whether Roth or traditional gets your next dollar comes down to the bracket bet we opened with. If you're not sure which side of that bet you're on, splitting between both is a legitimate answer, not a cop-out. And if you're a high earner locked out of direct Roth contributions, the backdoor and mega backdoor routes were built for exactly that. Just watch for the pro rata rule before you touch either one.
Honestly, none of this needs a financial advisor to get started. It needs you to know these levers exist, which most people your age just never were told. And notice something. Not one part of this depended on guessing which account is better in the abstract. Every piece depended on your actual numbers, your income, your old IRA balances, your employer's plan rules, your expected retirement spending. That's the difference between a generic answer and one that actually fits you.
Most people won't bother learning this stuff. It's not exactly dinner table conversation. Now you have, though. And if this was helpful, please subscribe, especially if you want to stay ahead of the parts of this that actually move the needle.